averaging with microcurrency futures. Now, a lot of people just kind of, they look at the micros and they think, well, that's just a waste of time. Who the heck would trade those? And to be fair, the microcurrency futures are not nearly as liquid as the full-size contracts or anything you might see in the minis or anything like that. It's a newer product and it's still kind of catching on. However, although you don't see a big daily volume in the micros, you must know that the micros are tied to the full-size contract, and the price pretty much moves right along step with it. So even though it doesn't have the highest volume in the world, your fill quality is still pretty good. The market makers there are great. I've never had a situation where we're unable to get in or out of a trade, or where we got a substantial amount of slippage. I mean, you will see a little more slippage on the micro than you would a full-size contract, but let's be realistic. The market maker is doing the best he can, and if you get slipped 2 ticks on a micro, it's like $2. So I don't think that's going to make or break anybody's trade. In this market, you're not scalping; it's usually position trading. The CME group launched the micro size futures basically in answer to the Forex market, which offered the micro lots, which attracted a lot of smaller traders, people that 10, 20 years ago, you never would have heard of speculators in, looking to trade currencies with 500 to 1,000 bucks. It just would never happen. But thanks to the Forex market that advertised the really small contract sizes and low margins, now it's something that the CME felt like they needed to match. And to be honest, I think I think they're great products. The margins range from 275 for the euro dollar to 182, and actually I think it's a little higher than this now. So I don't know what the exact margins are, but I mean, let's just say in the euro it's maybe 350 or 400, but even so, it's a great deal. And I don't think it's a waste of time, because what it does is it opens up the door for some strategies that maybe most of us couldn't afford to do before, and we'll kind of talk about that in a minute. Unlike the FX market, in which the pairs are standard in regards to which is the quote currency, the micro futures complex was created to make both Forex and futures traders comfortable. So remember before I said currency futures are very simple, they're all quoted in dollars, so there's no conversion or confusion. Well, that's true, but in the micros, the CME went a step further, and they actually offer the inverse pairs as well, so that if somebody that's used to trading Forex, they're used to trading the instead of the dollar yen, they want to trade the yen dollar, or vice versa. And in this case, I have an example of the Canadian dollar. Somebody that's used to trading the Canadian dollar, which is how it is in the CAD USD, that's how it would be in the normal futures market and the full-size futures, they can stick with that product. But somebody that's used to trading Forex and doesn't like to look at the inverse prices, and it throws them off a little bit, they can just trade the micro using the dollar CAD. So they can go both ways.
Yeah, I just looked real fast. The CME says that the for the micro 6E initial is 275, maintenance is 250.
Oh, it is. Okay, so it is.
Sorry about that. Richard has Richard has a question also. He says, does the maintenance margin add to the initial margin or replace it?
Okay, good question. It actually doesn't do either. It just acts as a threshold. So I'm just going to use purely hypothetical numbers. Let's say the margin on any particular contract is 2,000. Usually the maintenance margin is about 30% below that. And basically the idea is if you wanted to trade that contract, you would at least have to have $2,000 in your account. But you would, let's say that you put the contract on and you lost 100 bucks, so your account is now 1,900. Even though you're below the margin level, you're not going to receive a margin call in the futures market. You wouldn't receive a margin call unless your account drops below the maintenance level, which we'll just say, for hypothetical sake, we'll just say it's $1,600. So you could lose as much as $400 on your trade before you'd ever get a margin call. And keep in mind that $1,600 threshold, which is your maintenance margin, is only valid at the close of trade. So if you lose, let's say you lose at some point intraday, you're down about 600, but by the time the market closes, you're only down 300. So your account is above the $1,600 maintenance. You're good to go. You're not going to receive a margin call. So the maintenance isn't something that's added or subtracted. It's just simply a threshold that's below the initial margin that triggers a margin call. Okay, microcurrency futures are a great way to enter a relatively low leveraged position in the currency markets. Now, I'm sure a lot of you have read the book Hot Commodities by Jim Rogers. And if you've read that book, you'll notice that he makes trading commodities or futures. He's mostly talking about corn and some of the other ag products like that. But he makes it sound very simple. Like you just buy corn and you hang on to it for a little while. And you know why it sounds so simple to him? Because he's doing it with, he has a very large account to work with. He can buy corn and hang on to it for 3 years if he needs to. If corn doesn't go his way this week, he doesn't care. He'll buy a little more on a dip. And maybe 4 or 5 years down the road, he's profitable. That's how he trades. And for most retail traders, we just don't have the money to do that kind of trading. We don't have the wherewithal to withstand the ups and downs. We don't have the ability to add on if the market goes against us. But the E-micros really kind of level the playing field even for small traders, and it gives you the ability to do that kind of trading. There's a theory, and it is a theory, but commodities and currencies are the same way. They tend to trade in ranges. It's not like the stock market that historically has pretty much gone up forever. Currencies and commodities tend to be range bound. I mean, there's definitely extremes and troughs, but all in all, they really don't go anywhere, right? And it might take years for an entire cycle to play itself out, but they're still trading in a range. As a trading full-size futures contracts, it would take a pretty sizable account to do it, but in theory, if you had unlimited funds, you could really trade your way out of anything, right? If you could basically dollar cost average your position until the market finally turned around and you made some money. If you had unlimited funds, that would be possible. What E-micro futures does is it doesn't give you unlimited funds, obviously, but it allows retail traders with relatively moderate to small accounts to have that kind of mentality, that long-term mentality. You can put a position on in the euro currency, and if it doesn't go your favor this month, maybe it will next month, or maybe it will next year, but you can sit there and hold it. You will have to roll it over to the next contract month, but you're going to have some lasting power because the margin is so low. And if the market goes against you a little bit, you're not going to be so flustered and frustrated and scared that you exit. You might actually want to put another contract on and let it ride, and we'll kind of show an example of this in a minute.
Yeah, micros are good to cut your teeth on, is what I tell people. I mean, it doesn't matter if you're trading oil or currency or whatever. I mean, it's cheap enough, dollar per tick, that you can learn to get control of your psychological issues and so forth at a very inexpensive cost.
Yes, absolutely. I'm glad you brought that up. And I tell people this. I'm not a big fan of paper trading. I think paper trading, I mean, it's good. I'm not saying don't paper trade, but I'm saying, do it for a couple of weeks or a month, and then it's really all you're going to get out of it.
Yep, I agree.
The benefit kind of diminishes after that, once you get the feel of things, because it doesn't have that emotional aspect to it. So what I tell people is, once you paper trade for a little while, then go to the E-micros. That way, you're not going to be making or losing like your life savings in a week, but you will, even though it's a small dollar amount, you will start to get a hint of what the emotional aspect of trading is. So it's really a good way to start out for sure.
Couple questions. Arbach is asking, on what spot exchanges does the CME offset its risks?
I'm not sure that the CME does, or I'm not even sure they really carry any trading risk, because the CME is really just matching buyers and sellers. They're not taking any side of the trade, so I wouldn't imagine that they would even have any need to.
Right. I think that there's confusion there on like a smaller spot Forex bank that does actually take your trade, and then they need to go offset.
Right.
they have to find somewhere to offset. Whereas the CME, it's automatic. I mean, as soon as your trade is executed, it's already offset.
Exactly. Right. Yeah, we should clarify that. In the Forex market, you are most likely trading against your brokerage firm where, like Mike just said, they do have some risk if they don't offset it somewhere. But in the case of the futures market and the CME, nobody is taking any type of trading risk whatsoever. Your broker's not, and the CME is not. All they're doing is matching buyers and sellers. So when you buy a futures contract on the CME, they're matching you with some other, some other retail trader, or maybe it's a hedger. We don't know who the other side is, but it's another trader. There's nobody in the middle of that. It's just buyers and sellers together, and that's it. There's nobody taking a cut or skewing prices or anything like that. It's a pure marketplace.
Right. And then the last question that's up right now, Richard is asking, what are the costs of rolling to another month?
Okay. Rolling is just a real, futures brokers use it all the time, but it's really just a fancy way of saying getting out of one contract and getting into the other. So like, let's say, for example, we mentioned before that currency futures expire quarterly. Now, it's true that the CME will list contracts out, a year or two in advance. So in theory, you could say, all right, I want to buy, June of 2015 futures and just hang on to it forever. But in reality, that it doesn't work that way. Especially with the E-micros, you're going to find that there's really, and even in the full-size contract, this is really mostly the case, the liquidity is really in the front month only. So you're pretty much stuck trading the front month, and that's not such a bad deal. It just means every 3 months you have to roll over, and like I said, that just means, let's say that we're long the December futures, and towards the end of December we realize that we want to continue holding the position. It actually would probably be like early December, but anyways, if you want to continue holding the position, you'd have to roll into March. So what you would do is you would sell the December that you were holding, and then you would buy a March futures. So your only cost is really the commission, whatever the commission is that you worked out with your brokerage firm. That's your only true cost. You do want to keep in mind, though, that the December futures is probably going to be trading either at a discount or a premium to the March, and so on and so forth. So you are going to, for example, if let's say I'm just going to look and see what the March futures is right now. So like if you were holding a December futures contract, right now we'll just call it 134.55. And you were rolling into the March, actually there's not much of a spread whatsoever. The March right now is at 134.57, so you'd essentially roll over with your only cost really being the commission.
I just looked, but the volume is
pretty simple.
Like 600 contracts.
Yeah, you really don't, you wouldn't want to roll over yet, for sure.
I've seen,
and it's, like I said.
Yeah, sorry, I've seen on some commodities like oil, maybe not the currencies, but like on oil, I've seen decent liquidity usually in the December month, for whatever reason.
Yeah, you'll find in commodities there is a lot more. I think it's because because of the hedging and all of those types of things. In commodities, especially like the grains and crude oil, you'll see liquidity several months out. In the financials, so treasuries, stock indices, and currencies, really there's only liquidity in the front month. If you try to go any further than that, you're just doomed. So stick to the front month in currencies. And it's not so bad. If you have to roll over 4 times a year, 4 commissions, It's not that big of a deal. I mean, assuming that you're in the trade for that long. Even with an E-micro position trade like this, you're probably not going to hold on that long. But if you did, it wouldn't be the end of the world, as far as costs go anyway. So the idea is dollar cost averaging. I mean, you hear it all the time in your stock investment accounts, but you don't hear that a lot in futures because, quite frankly, most people just don't have the money to do that sort of thing. But we'll show you how maybe with the E-micro futures you could have maybe brings a whole new strategy to mind. So this was actually a couple of weeks ago. We took this snapshot chart of the euro, when the euro was trading somewhere up around the 135.50 level. Now, a trader might have looked at that and said, well, the 2-year high was just a little higher than we are now. So I don't know about you. I mean, everybody has different strategies, but my personality tells me if something's really high, I want to be a bear, or if it's really low, I want to be a bull. So someone like with my type of personality might look at this and say, well, with an E-micro, I could sell some futures here, or A futures, we'll start with one, with pretty low risk, right? I mean, if we go up and touch the 2-year high, we're talking maybe another 100, 150 points. In an E-micro future, let's just say 150 points higher, that your risk is like $200. So to me, that that seems like a pretty manageable way to start. And let's assume that as we're planning this trade out, we know that it's about a $200 risk if the market retests the 2-year high. We can take a look at back in October of 2011. The market kind of peaked out around 142.36. So if we really wanted to be in the euro for the long haul, we might say, well, we're willing to ride it all the way up to the 2011 fall high, maybe even add on a contract there. And at that point, we're talking about a $750 loss on the original, which obviously $750 is real money, and it stings a little bit, but it's probably not going to blow your account out. And at that point, you might be even more comfortable saying, hey, I'm going to put on another contract. Because now we're at 3-year highs, and I'm still bearish fundamentally. So in theory, if you really, really felt strongly about being bearish the euro, you could incorporate into your game plan that, I'm just going to be willing to ride this thing out to the April of 2011 high. And if this chart went back a little further, you'd notice that the all-time high is around 160. So it's honestly not that far under the all-time high. So you're talking about starting a scale trade that potentially, even if we got up to the highest price we've seen in 3 years, which is probably not likely, you're only talking about $1,600 loss on the original contract and $1,000 loss on the other. And again, I'm not saying that's not a lot of money, but if you've ever traded the full-size contracts, you would know that $1,600 loss on a full-size contract is like maybe a day or two.
Right.
So,
whereas this could take
puts things in perspective.
Right.
So,
this could be weeks or months for this to happen.
This could be months, years. Yeah, this could take forever. So, and obviously you don't want to lose money, but if you did, kind of scale up, you'd be in a pretty good spot. I mean, being short 3 contracts from 150 in the euro, shoot, I wouldn't mind being in that position, even if you are carrying a little bit of a, some weight. And then in this slide, it gives you an idea of kind of what might have happened. Let's assume that the market went all the way up to 150 and you were able to get that 3rd contract on, and let's say that the market peaked out, your break-even point is going to be at 142.60. So all the market would have to do was get back down to 142.60, which is still historically a very high price for the euro, and you'd be breaking even. If the market returned to the original price that you originally started selling, you'd be making $2,500 on a trade that honestly your risk, I mean, you can never say what your max risk was, because maybe the euro could go higher than 150. I highly doubt it, but anything could happen. So even though we were kind of saying our max risk was approximately 2,600, it's possible it could have been a little more, but with that said, hypothetically, even if the market only came down to where we originally started selling, meaning we were basically wrong right off the bat, you'd still make $2,500 on an E-micro. And to be honest, you probably wouldn't have been uber stressed out. I mean, it depends on your financial standing, but I would venture to say that most traders wouldn't have been ready to jump off the bridge with a $2,000 loss, and they know historically that the euro probably is going to have a tough time sustaining near all-time high prices. So the odds of something like this are pretty favorable. If, let's say that the trader sold around 135 and they were right off the bat and the market pulled back, if the market came down to the lower end of the range, somewhere around 128, it's a $1,000 profit, which isn't too bad for a margin of $275 or whatever it is. So this basically, all I'm trying to point out here is you can trade like the big boys with a very small account if you use the E-micros. I mean, this is what, when I talk about the big boys, this is what they do. They don't have to be right away. Like somebody in a small account trading a full-size futures, there's not a lot of room for error because the market moves so fast for you or against you. But what the big boys do, that have big, giant, sizable trading accounts, you know, they can put a contract on, and if they're wrong, they put another one on. And in theory, they could sell their way out of being wrong eventually, assuming they didn't have any capital limits. So this kind of opens the door to that type of mentality for smaller traders.